Are you concerned that there's a bubble?
It is a bubble. The question is, when will the bubble
Why is
pop?
everyone continually being
And if they fall short of expectations, then quote, investors will pull back and the bubble will pop.
Everywhere you look, there's talk about the next big stock market crash. The market's been setting record highs again, and a lot of that excitement has come from the AI related companies. Nvidia, Google, Microsoft, Oracle, AMD, all playing a huge part in pushing things upwards. At the same time, you'll read stories about investors like Warren Buffett stockpiling cash. And it makes you wonder, does he see something that the rest of us don't? That's the tricky part. Whenever a single theme starts dominating the market, whether it's tech, crypto, real estate, or now AI, the same question comes up. How long can it last? Are we looking at the start of a new era or the build up to another bubble? Today, I'm not here to predict what happens next. I want to share how I plan for whatever the market does. Let's first take a look at the current setup and what might be driving all this momentum. Over the last few years, we've seen a massive wave of excitement around artificial intelligence, and it's completely reshaped parts of the stock market. Companies that build AI models, supply the chips, or provide cloud infrastructure behind them have all benefited. Stocks like these have grown so quickly that they now make up a huge portion of the major indexes, and a big part of the recent growth has come from a handful of companies that have performed well with this AI surge. Their movements heavily influence its overall performance. A lot of investors see this as the next technological revolution, and to be fair, that comparison makes sense. New technologies do create big shifts in the market, but when optimism builds up this quickly, prices start reflecting a lot of future success or expectations, sometimes more than what's realistic in the short term. That's what people mean when they talk about a potential AI bubble. Now, none of that means a crash is guaranteed. Markets can stay expensive for years, and predicting the top is impossible. But what is clear is that we're in a period where expectations are high, valuations are stretched, and a lot of investors are crowding into the same trade. Bloomberg even created a graphic showing how money and partnerships move within the AI world, and it's almost like a web. You've got companies like Nvidia, OpenAI, Microsoft, Oracle, and AMD all investing or relying on one another. Nvidia invests in OpenAI, AI signs massive cloud deals with Oracle, Oracle spends billions on Nvidia chips, and it keeps looping around. It's a fascinating cycle, and while it shows how central AI has become, it also raises a question. How much of this growth is driven by genuine new value, and how much is just the same money being circulated around the same companies? That's the kind of setup that can push prices higher in the short term, but it can also make the system more fragile if confidence starts to fade. One way to see that is through price to earning ratios, or PE ratios, and that's a simple measure of how expensive a stock is compared to its profits. Many AI-related companies trade at PE ratios which are far above the market average. That tells us investors are paying for what they believe these companies will earn years from now, not just from what they're earning today. And history has shown us that markets move in cycles. There are these bursts of innovation followed by periods of correction. It's never exactly the same, but the pattern of excitement, overconfidence, and adjustment tends to repeat. So the question isn't if the market will shift again, but how we react when it does. So instead of trying to guess when that turning point might come, I think it's more useful to focus on what we can actually control and how we can prepare for whatever happens next. So that brings me to my first principle. Nobody knows the future. It sounds obvious, but it's one of the hardest things for investors to accept. Every time markets reach new highs, you'll hear confident predictions about an imminent crash, and every time the markets fall, you'll hear the same confidence about how much further they have to drop. But the truth is, no one, not economists, not fund managers, not even the best investors in the world, can consistently predict what's next. Even Peter Lynch once said that far more money has been lost by investors preparing for corrections than in corrections themselves. And think about that. People pull out of the market waiting for the perfect time to buy back in, but that perfect time almost never comes. The market can stay irrationally high or unexpectedly strong for far longer than anyone expects. When things look terrible, that's often when the best opportunities quietly appear. Because even if you do manage to sell at the right time, you also have to be right again when buying back in. That means you need two perfect decisions, and the odds of that happening consistently are very small. In 2000, after the hype around the internet, the dot-com bubble burst and wiped out trillions in market value. In 2008, the global financial crisis, the system itself looked like it might collapse. And in 2020, the pandemic triggered one of the fastest crashes and recoveries we've ever seen. Yet every single time the market eventually found its footing and moved forward. So instead of trying to predict when the next crash will happen, I focus on how to behave when it does. So if nobody knows the future, the next logical question is, what can we actually do about it? And that brings me to the second principle, which is diversification. When you look at the history of the stock market, one thing becomes clear: the industries driving growth are constantly changing. A few decades ago, the market was dominated by manufacturing, energy, and traditional industries. Today, technology makes up a huge portion of the global stock market. That shift didn't happen overnight, but it shows how the market keeps evolving. Some investors back then could see technology's potential, but even they couldn't have predicted which companies would end up shaping the future, or how quickly it would happen. And that's the challenge. You might get the trend right, but it's much harder to know who the lasting winners will be. Finance professor Hendrik Bessenbinder looked at nearly a century of data and found that just a small fraction of companies account for nearly all of the stock market's long-term gains, and most individual stocks underperform or eventually disappear. And that's why diversification matters. By owning a mix of different companies, sectors, and countries, you don't have to guess who the next big winner will be. You just need to stay invested long enough to benefit from the overall growth of the market. Because the truth is, the market 20 years from now will probably look as unfamiliar to us as today's market would have looked to investors 20 years ago. The names, the industries, even the technology, they all change. So rather than betting on one story or one theme, I'd rather build a portfolio that can survive many different stories, including the ones we can't see yet. So far, we've talked about accepting uncertainty and spreading our investments to manage risk. But even if you're well diversified, there's one more thing that can make or break your success, and that's your behavior when markets fall. Because when a crash does hit, it doesn't just test your portfolio, it also tests your emotions. And that's where this third principle comes in: only invest money you don't need in the short term. This idea comes up often in the writings of people like J.L. Collins, and it's one of the most simplest but most powerful rules in investing. If the money you invest is something you need soon, you'll always be tempted to sell when things get rough. And that's usually when the market is at its worst. Crashes don't just lower prices, they also lower confidence. People start feeling poorer, more anxious, and more desperate. And that's when many end up selling at the bottom. But if your long-term money is separate from your short-term needs, you don't have to react. You can sit through the volatility and let the recovery do its work. And here's the thing, if your plan is truly long-term, a drop in the market can actually be an opportunity. Lower prices mean you're buying more units for the same amount of money. So it's like you're getting a discount on your future returns. But that only works if you have patience and discipline to keep investing when everyone else is panicking. History can't tell us exactly what the next crash will look like or when it will happen, but it can remind us that these things do happen on a regular basis. Since 1938, there have been around 30 bear markets, each with drops of 20% or more, and on average that's one every 5 to 6 years. They all look different, but the pattern was the same. Markets fell, people panicked, and eventually they recovered. So while the past can't predict the future, it can prepare us for it. And if you're ready for those moments, if you expect them, stay invested and keep your focus on the long term, you put yourself in a very good position over time.